Okay, let's look at some of the sales associate math problems. First one is broker and agent commission split. Here's a question. We're just going through questions. Home price 100,000, 7% commission. The broker's split is 50-50 between the other brokers. Sales associate receives, say, 60%, and the selling associate lists and sells. So how much does the associate and the broker get? So this is probably one of the simplest math problems you'll see on the exam. Home price is 7%, and therefore commission is home price is 100,000, commission is 7%. Therefore the commission is 7,000. It's going to get split two ways between the listing broker and the sale broker, or the selling broker, which is 3,500, 3,500. And the question states that the selling associate lists and sells and receives 60%. So how much do the associate and broker get? And really, you just multiply that by 60. Obviously, the broker ends up with 40%. How many acres in a section? One of those, you know what we are talking about. Here's the question. How many acres in the north half of the northeast quarter, the southwest quarter, and southeast quarter of the northwest quarter? The thing you always look for in these questions is the word and, because that means you're going to have two mini problems, the results of which will end up at the end. We always start off with what number? 640. And literally, I'm doing the first one. I just take the the denominators, and this is divided by 640 divided by 2 divided by 4 divided by 4. That equals 20. Then I do another 640 divided by 4 and divided by 4 equals 40. Total answer 60. Look for that word and. That's really going to help you. Gross rent multiplier. This is in the income section. Unit 16, I believe. The property sold for $229,400. The monthly rent is $1,850. What is the GRM? Now I think of the R as rental, and when I think of rentals, I think of monthly. So basically the question is asking how many times does 1850 go into 229,400? And that will give us a figure which is an index, which we call the gross rent multiplier. In this case it's 124. If I knew that the rent was 1850 and I knew that the gross rent multiplier was 124, then multiplying those two out would give me the value of 229. If I knew that the value was 229,400 and the average gross rent multiplier in this area is 124, then I know I should be expecting about 1850 a month rent. That's how that one works. Because then we go on to the income multiplier. This is gross income multiplier, which is based on a year. Because income, I always think of rent, monthly, income, yearly. And it says the property produces 50,000 per year gross income and a net income of 35. A little bit of a distractor there, because we don't need to take that into account. We're after gross income, and that's where we are there. And the property sold for 400,000. What is the gross income multiplier? In other words, how many times does that 50,000 go into the 400,000? And the answer, of course, is 8. Working it another way, if I know that the area GIM is 8 and I'm getting $50,000 out of this property per year, then I would expect to pay 400,000 for it. Or if I knew the property was worth 400,000 and I knew the area GIM was 8, then I would be expecting to get at least 50,000 per year income out of it, gross income. Cost per square feet or square foot. This is a very simple question, but people get it wrong so often. I have a property which cost me $21,780 per acre. Obviously a very expensive piece of land. What is the cost per square foot? Well, I know there's 43,560 square foot in an acre, so basically I pay 21,000 for 43,000 square feet. Working on that assumption, I know the figure is going to be less than $1, because if I paid $1 a square foot for an acre, it would be $43,000, but I'm only paying $21,000. So if you get an answer 1 point something, then you did it the wrong way round. Very simply, 43,000 into 21,000, and that will give you 50 cents per square foot. If you did it the other way around, you're going to get $2 a square foot, which just doesn't make any sense. Apartment building sold for $250,000. The land is valued at $50,000. What is the annual depreciation for the IRS deduction? Now remember, what we're talking about here is we do not depreciate land, we only depreciate the building. So the land, with all the trees and the green grass, I've got to take away. Should disappear. Whoops, there it is. So what is the building value? Well, obviously it's the 250 minus the 50, which is 200,000. This is an apartment building. That means it's residential. And for IRS deduction depreciations, we use 27.5 years for residential, 39 years for non-residential. It may be a commercial building, but it's still residential. People get confused with that as well. So what we do, we get the 200,000 divided by 27.5, and it gives us 7,273 per year annual IRS deduction from our income taxes. Here's an office building sold for $2.35 million, and the land was valued at $250 at an appraisal. We've got two questions here. What is the annual depreciation for the IRS deduction? And what is the depreciated value of the building after 5 years? Once again, we're not talking about the land when it comes to depreciation. We have to take the land away. So how much is the building worth? We've got the 2.35 million. The land is 250,000. Take that from the 2.3 and we get 2.1 million. So this is the value on which the depreciation is based. This is called the basis. Building is non-residential. So the office building sold for 2.3, so I beg your pardon, the building is non-residential, the building value is 2.1, so what are we going to do? We're going to divide it by 39. It gives us 53,846 per year. So that's the answer to the first question. The second one is, what is the depreciated value of the building? So what we have to do there, and therefore the total depreciation over 5 years is 269,230. Take that away from the building value of 2.1, and we get now a book value of 1.83. All right, now we've got the home housing expense ratio and the total obligation ratios, HER and TOR. Remember, these are relevant when it comes to qualifying for conventional or FHA or VA loans, and we need to ascertain those with a person's income and expenditure. For the FAA, it's a 31% housing expense. That means the FHA, did I say FAA? FHA, they actually only expect you to pay or spend up to 31% of your gross monthly income on your monthly housing expense. And they expect a total of your total obligations, which includes housing expense and other bits and pieces, to not exceed 43% of your gross income. VA, they just check you basically on 41%, or that's what the book tells us, and that means the VA only check on the total obligations ratio. So here's an example. Oh, and conventional, beg your pardon, is 36%. And the reason it's a lot lower is because there's more risk with the conventional, because it's not guaranteed or insured by the FHA or the VA. And remember, the VA guarantees and the FHA insures. No, you can get private mortgage insurance, which will allow this maybe to go up a little bit higher and lower your interest rate down a bit, but that all depends on individual circumstances. Here's an example of how it works. The principal, interest, tax and insurance is $900 per month. The monthly insurance premium is $150, car payment is $200, and the student loan is $150. Gross monthly income is $3,500. What are the HER and the TOR? Let's do things the HER first. So the HER is the PITI, which is $900 plus the insurance, because that is part of the housing expense, divided by the gross monthly income. So we get the 900 plus 150, which equals 1,050, and we get that 1,050 divided by 3.5, which equals 0.3. And remember, we don't know what sort of loan this is for FHA loan, so if we go back to where we were, we can see that an FHA loan we were expecting 31%, so we just squeezed in there. Then the TOR, which is the PITI 900 plus the 150 plus the long-term payments, so that's the 200 plus 150 divided by the 3,500. So therefore, what we get here now, there's the PITI, the monthly insurance premium, the car and student loan, which equals 1,400 divided by the 3,500, and that is 4.4 or 40%, which once again is okay because we're allowed up to 43% on the FHA loan. And the same works for the other types of loans. But you do have to remember those, please. You do have to remember these figures here. Loan to value calculation, very simple. What percentage is the loan of the total home value? Loan is 180, value is 200,000, therefore the down payment is going to be 20,000. Divide the 200 into 180 and it'll give you 0.9 or 90% loan to value. If you do it the wrong way around, you're going to get 110 or something, which is 1.1 or 110%. Obviously that's not right. How about this? We have a $240,000 loan with a $60,000 down payment. They don't give us the home value, but we can obviously see that it's those two added together, 300,000. The loan is 240,000, so we divide that out and we get 0.8 loan to value. This is one of the simpler calculations we have in the math. A percentage lease. A percentage lease is when you will pay a fixed base rent per month, in this case $1,000, and anything over a certain sales volume you will pay a certain percentage on. You're going to pay 3% of annual gross sales above 325,000. They have to give you what the actual sales volume was. In this particular case it was 450,000. What is the total rent? So we get the 450 minus 325, which gives us 125,700, and is subject to that is subject to the 3% charge. So 3% of that is 3,771, plus of course we got the base rent of $1,000 a month, which is 12,000. Therefore the total yearly rent will be 15,771. A variable lease. Variable lease is where you have usually a price per square foot, and that price per square foot is based on an index. We don't care what the index is or where it comes from. Let's supposing it's the consumer price index. It may be another index. It may even be the GRM or the GIM index. But in this particular case, we're basing it on an index. And in the question it says the rent is, or was rather, $12 per square foot. The old index was 1.5 and the new index is 1.8. So what we've done is basically increased our index by 1.5 from 1.5 to 1.8. That gives us a certain percentage increase. We need to apply that percentage increase to that $12 per square foot. And how we do that is we get the old index. And what is the new rent? We get the old index and divide it into the new index. And that's going to give us 1 point something. And then we multiply it by 12, and that gives us the new rent. So new index over old index times the old rent. That's working out on income property, the spreadsheet that goes from the potential gross income to the net operating income. This is something you must commit to memory, the order in which things have done. The records indicate the effective gross income. This is a particular strange question. Is 560,000 and the vacancy losses are 10%. Total operating expenses are 265, which includes 56 reserves for replacements. I'll put here, watch it again, watch it again. What is the net operating income? Now remember at the top we had PGI, potential gross income minus the vacancy losses gives us effective gross income. Well, we're already gone past the vacancy losses and that, so we know that we're now on the 560,000. From that we take away the operating expenses, which includes the 56, remember, so we don't include that either. So literally all I have to do is take the 265 from the 560, and that is going to give me the net operating income. If you have any problems with this, go to the book, Unit 16, and go through the income approach again and figure out exactly what order the PGI down to NOI is. And that gives us a net operating income of 295,000. Calculating lots per acre. If you own a developer, you buy a tract of 100 acres, and the zoning says you have to have 9,000 square feet per lot. And I know I'm going to use 25% for streets and sidewalks. How many lots can I get in there? Lots of different ways of doing this, but in this particular case, we look at it per acre, 43,560 square feet in an acre. We take away that 25%, which is going to leave us 75%, so we multiply it by 0.75, which gives us 32,670 available square feet for lots per acre. So 32,000 times 100, that gives us 3.2 million square feet total available for lots. We're allowed 9,000 per lot, so we divide that out and you come up with 363. If it says 363.5, then obviously we can't have 0.5 of a lot. Even if it says 0.9, we still can't have 0.9 of a lot. Therefore, we always round down on this one to the nearest whole lot. Here's some taxes for you. Remember the 25 plus the 25,000 plus the 500 extras for fully handicapped people, totally disabled, or widow or blind, or 5,000 for a 10% military veteran. So you've got to look in the question, make sure there's no added bits. In this particular case, the owner is blind, so let's have a look and see what we've done here. The school taxes. Well, first of all, we can take off 25,000 plus the 500 exemptions, which is 25,500. We've got the 165,000 minus the 25,500, which gives us 139 taxable value. Multiply that out by the 0.6. The school taxes are 837. City and county rather. Remember, it's over 75,000, so we get the 25 plus the 25, plus we get an extra 500, which means total exemptions of 50,500. Take that away from the 165,000, and you get the 114,500 taxable value. Because we're doing it on both of these, we can add these together. I personally do it separately, but the book shows us to add them together. It's up to you. But when we add those together, it comes to 0.179. In other words, it comes to 17.9 mils. And you multiply those out by the 0.0179, and you get an extra $2,000. So the total taxes will be $2,886.55. This sort of question needs a little bit of a memory process and also practice. I would suggest you do at least 5 or 6 or 10 of those questions out of the main book, and if you've got the review book, out of the review book. special assessment calculation. Remember, this is when they build the tarmac road in front of your muddy, eroded house. When we talk about lot dimensions, we always regard the first dimension when we're talking about a lot size as the frontage, which is adjacent to the road, and then the depth of the lot. And we always calculate it cost per linear foot. The word linear comes up in the question. Linear means literally if I draw a straight line from one corner of the frontage to the other corner without taking into account any curves in the actual frontage. And then there'll be the total paving cost and whatever the property owner's share is. And always remember there's two sides to every street, so you divide by 2. Here's an example which you've seen or will see if you're looking at this in advance. We've got 3 houses. This is a particular house I'm talking about. It's 100 foot frontage. It's got a mud road in front. The owners petitioned the local municipality to put in a tarmac. They say it's going to cost $24 per frontage foot to build this road, and they will pay 30%, therefore they expect you to pay 70%. So let's work out how much in front of me is the road going to cost. Obviously 100 feet times 24 is going to be 2,400 feet, but then I have to pay 70%, which is 1,680. But of course on the other side of the road there's 3 folks living, and they can pay their own fair share, and therefore we divide by 2. Total cost 840 would be my special assessment, which will be added onto my tax bill under non-ad valorem taxes. Documentary stamp tax on the deed. Essentially, the documentary stamp tax is how many $100 bills are we paying for this particular house? Or am I selling it for? Whoever writes out the deed. When the deed gets recorded, they want 70 cents for, the state wants 70 cents for every $100 bill you put down on the table when it comes to paying for the house. Usually the seller pays for the deed stamps, all depends on the contract. So on the seller, on the closing disclosure, it would be debit the seller, but we do not credit the buyer because this is a straight cost to the seller that goes out of the transaction over to the state. Here's an example. A property sells for $260,000 and $260,001. Well, we divide that out by 100, and $2,600 $100 bills wouldn't do it. We have to round it up to that 01 because there's just a little bit of a dollar bill left over. Therefore, that's the one we multiply out. It's going to be $18.20 and 70 cents. We talk about the documentary stamp tax on the promissory note or the mortgage note. This is the same way we work it out. We divide it by 100, but instead of multiplying by 0.7, we multiply it by 0.35, 35 cents for every $100 bill of the mortgage loan. This is the note, and we do it on all notes. You divide by 100 and round up, and then multiply by 35 cents. Is charged on all old notes and new, but not for subject to. They just mentioned that in the text. A subject to mortgage is when that includes another mortgage which has already been recorded. Don't worry too much about that. And buyer normally pays because it's normally the buyer getting the loan. So it will be just a straight debit to the buyer, but not a credit to the seller because it's outside the transaction going to the lender, to the state. So here's an example. We have a mortgage note of $208,535 divided by 100. Because we have got a little bit left over, we have to round up to 2086. Multiply that by 0.35 and you're going to get the stamp tax on the promissory note of $730.10. Intangible tax on the new mortgage document. This is only on new mortgages, not notes. We covered notes. This is the new mortgage. This is a 16-page mortgage document. And it's only on new ones. When a new one is recorded, and this is when it is recorded, then the amount on the mortgage is just multiplied by 0.002. Only charged on new mortgage documents. So here's an example. The new mortgage amount is 208,535, and then there's a straight 002, which equals 417.07. So here's an example. What is the state intangible tax on an assumed mortgage document? On an assumed mortgage document. Go back to here. Not assumed. So the answer there should be 0. Let's supposing it was a new mortgage document. What would be the intangible tax? 120,000, a straight 0.0, sorry, on the new mortgage document. So which is it? Do you divide by 100 and multiply by 0.35, or is it a straight 0.002? It's on the mortgage document, not on the note. Therefore, it is the intangible tax of 0.002, which is $240. This is something you have to go through many times so you don't get them confused. And here's a typical example you may get. Home price is 2.5 million. First mortgage of 55% of the price. Assumes a second mortgage of 250. What are the total stamp taxes due on the transaction? The deed. Taxes on the deed is a straight divided by 100. If it comes out okay. And the way to make sure it doesn't round up is to look for these last two figures on the number you're working. If these last two figures are 00, then you know it's going to be a whole number when you multiply, divide out rather by 100, and therefore there's not going to be any requirement to actually round up. But if these two numbers are not 0 and 0, then you know you're going to have to round up. 25,007 times 0.7 is 17,000 just on the deed. Then we go on the first mortgage. The first mortgage, which is we assume is a new mortgage, is 55% of the price. We have to work out what 55% of 2.5 million is 1.375. That's the one now that we then go and divide by 100. Because we have to round up from 3.85, we go to 4. Multiply it by 35 cents and you get the 4,000. Then we have the intangible tax on the first mortgage. The first mortgage was 1.375, so just multiply that out. And then on the second mortgage, and then we have just taxes on the second mortgage note. So on the assumed note, 250,000 divided by 100 and multiplied by 0.35. But of course there's no intangible tax because it is an assumed mortgage. So we add all that lot up and it's $25,000 taxes on that whole mortgage for this really very nice $2.5 million home. And I guess if you can afford $2.5 million, you can afford the 25,000. Net monthly income of a property. This is once again a PGI down to NOI deal. The expenses are $1,200 per month, 8% return. What is the building value? Once again, you have to know the order in which the PGI, the vacancies, the expenses, and the NOI work, and how the NOI is related and capitalized back to the value. In this particular case, the net monthly income is $3,000 per month. The expenses are $1,200, but we can ignore that because they are already taken off before we get to the net monthly income. But the thing is that what we need to do is work it on an annual basis because this is what the 8% return is. So we have to first of all find out what the net operating income for the year is, which is going to be 36,000. 36,000 represents 8% of the building value, and therefore we bring in Uncle Irv. And we'll put 36,000 here, and 8% here gives us the value. That should be 36,000, I beg your pardon. Oh yes, here it is, 36,000, and divided by 8% gives us 450,000. The 3,000 times 12 gives us 36,000. Divide that by the 8%, and it gives us 450,000. Property has 4 2-bedroom units at rent for $1,000 and 2 3-bedroom units at rent for $1,200. Vacancy and collection losses are 5%. Management fees are 10% of the effective gross income, and other expenses are $3,600 per month. Read the question first before you start working stuff out. What is the yearly vacancy and collection loss amount? Okay, so what they're basically saying is what is the PGI and what is 5% rather of that PGI. All the rest of the stuff is irrelevant. So we have to work out first of all how much does the 4 2-bedroom units rent out per year. So that's 4 times 1,000 times 12 is 48,000. The 2 3-bedroom units are 1,200. Therefore times 12 is 28,000. The total of that is 76,000. And then we would that's the PGI. Then we take off the 5% because this is what they're asking for. What is 5% of that? 3,840, which is your answer. So make sure you read the question very carefully, because you may automatically assume that they're working their way down and doing stuff. Make sure you do it in the right order and don't put in stuff that isn't needed. This is probably the second easiest question in the book. Livable area is 45 times 6 at 1,220, and garage is 24 times 24 at 58. What is the total cost to build? So let's look at the livable area first of all. 45 times 60 times 120 is 324. 24 times 24 times 58 is 33. Total cost is 357. That's the total cost. Okay. Property taxes. Property taxes are paid in arrears, except when the seller has already paid the taxes. In that case, they're prepaid taxes, but we normally talk about unpaid taxes. First of all, you divide the total tax bill by 365 days. And if they're unpaid, you multiply that result by the number that the seller has lived in the house, number of days. And on the closing statement, it will be debit the seller, credit the buyer. Here's an example. The taxes are 3,224. Sale date is June the 12th. Use the 365-day method. They'll always put that in the question. Here's a little year timeline. I just put in taxes are normally paid in November the 1st onwards. So you can't pay the taxes before that date. Therefore, anything that happens before November the 1st is probably going to be an unpaid tax problem. You've got to work out how many days is a seller who's lived in the house without paying taxes going to hand over taxes to the buyer who's going to have to pay the full tax bill. This is how we do it. First of all, you divide out the tax bill by the days, which is 8.83288. Leave that in your calculator because we'll be multiplying it by quite a large number. We don't want it to get errored. 30 days has September, April, June and November. All the rest of 31 except February, which has 28 days. You have to remember this or use the knuckle method. In this particular case, it's 162 days. Remember, we always say that the day of closing belongs to the buyer. So therefore, the seller is not going to pay the taxes on that day. So here you see June, they only use 11 days. Be careful of that, because if you're 1 day more, there won't be 162, it'll be 163, and this figure will be just $8 more, and it'll be one of the wrong answers. And in this case, it's debit the seller, credit the buyer. How about how to prorate yearly HOA fees that have been prepaid? Fees are $450 per year. Sale date is June the 12th. Use the 365-day method. Now in this particular case, the fees have been paid by the seller, but the seller's not going to be living in the home all the year, and the buyer's going to be living in the home for some of the year without having to pay HOA fees. Well, that's unfair on the seller, who has forked out a whole year's worth. So therefore, we're going to have the same sort of thing. We divide the 450 by the 365 days, But in this particular case now we have to work out how many days has the new buyer lived in the property, so they can hand back that number of days times the per day cost to the seller. So it's going to be debit the buyer, credit the seller in this case. Well, I know there were 162 days. You can work it out different ways, or you can work it out. Remember, we do include June the 12th. So June the 12th to June the 30th is 19 days plus the other days, 203 days. Or you could have got the 162 which we had from the previous one and taken away from 365, and that'll still give you the 203 days. If I'm going too fast for you, if this is getting a little bit beyond you, then you need to catch up, because what I'm doing now should be second nature to you before you take the exam. I'm not going to do the monthly ones. The monthly ones are exactly the same. Let's have a look and see what else we got. To prorate collected rent, we have a duplex, 700 each per month. Sale date is June the 12th. Now in this particular case we are just talking about June, because the landlord has collected obviously $1,400 from both the tenants, but is not owning the property for the whole month. Therefore some of the money has got to go over to the buyer, because the buyer actually owns the tenant for 19 days. So what do? We work out how much per day it is, and if this was July we would divide it by 31, but it's June, so we're dividing it by 30. $46.67 a day. How many days has the buyer lived in the property? 19. Therefore we have got to hand over, the landlord has got to hand over 19 days worth of rent to the new buyer who owns the tenant for that 19 days. On the closing disclosure, it's going to be debit the seller, credit the buyer. How about how to prorate interest on an assumed mortgage? The buyer is assuming the current mortgage on the property on May the 8th, the closing is, and the balance at the 1st of May was $93,600 at 4.5%. So we have to work out what is the interest rate, or the interest in dollars per day on this mortgage for the month of May. And then, because this seller hasn't paid the mortgage and the buyer is going to be paying the mortgage at the end of the month, the seller is going to have 7 days borrowing that money without having paid the mortgage. So this is what we have to do. We have to get that 7 days worth of mortgage payments, interest rather, and hand it over to the buyer. So who pays to whom and how much? Let's have a quick look. First of all, we've got to work out exactly what the rate is per day, and that is 93,000 times the 4.5% divided by 365, 11.539 per day. Leave that in your calculator, because we're going to multiply that out by 7 days, and we don't want the error to get too large. So how many days has the seller not paid interest? Obviously 7 days. Multiply it out, debit the seller on the closing disclosure, credit the buyer, and it's going to be $80. And remember, when we're doing these prorations, whatever comes out of one pocket always goes into the other, so the number is always the same. Okay, finally, we're just talking how certain items are entered on the closing disclosure. So first of all, the purchase price. Well, the purchase price is pretty obvious, because the money's got to come out of the buyer's pocket into the seller's pocket. So it's going to be debit the buyer, credit the seller, or credit the seller, debit the buyer. Doesn't really matter which way you do it. Then we have the earnest money. The earnest money comes from outside the transaction, so therefore is only going to go into one pocket first of all. Therefore it's going to be actually just credit the buyer only. It's not going to be debit the seller or anything like that. Unpaid property taxes. We've just done that. How's that going to be? The seller has got to pay the buyer for the property taxes that will be paid later on in the year. So it's credit the buyer, debit the seller. Agent commission. We all love that one. Who normally pays the agent commission? It is the seller. Therefore it's going to be purely the seller, out of the seller's pocket, debit the seller only. Loan origination fees. Who normally pays for that? The seller doesn't care about whether there's cash or a loan. So it's nothing to do with the seller, it's only to do with the buyer, so it comes out of the buyer's pocket. Seller's mortgage payoff. Now when the seller's still got an outstanding mortgage, that money has got to go out of the transaction, out of the seller's pocket, over to the original mortgagee, the bank. Therefore, it's going to be debit the seller only. These are tricky, I know. Prepaid HOA fees. They've been prepaid, therefore the buyer doesn't have to pay them for the year, which isn't fair, so it comes out of the buyer's pocket into the seller's pocket. Debit the buyer, credit the seller. New mortgage. Well, the new mortgage is basically the same as the earnest money. This is money coming into the transaction to pay for the property, and it's going to go into the buyer's pocket. And there we go. Okay, let's assume mortgage. Let's assume that the buyer is taking over the seller's mortgage. Therefore, instead of him having to pay off the mortgage himself, he's going to give it to the buyer. Therefore, it's going to be debit the seller, credit the buyer. We've got paid property taxes. That means the seller has prepaid the property taxes, and the buyer is going to be living in the home for the rest of the year. It's probably going to be after November the 1st, the closing. And they're going to have to give back a little bit because he won't have to be paying any taxes. Debit the buyer, credit the seller. Unpaid interest on an assumed loan. Well, we saw that just a little bit earlier. The buyer is going to be paying the full interest on for the whole month that the mortgage was for, but he hasn't lived in the home for the whole month, so he wants some money out of the seller. So debit the seller, credit the buyer. And mortgage points. Mortgage points is a loan cost and nothing to do with the seller, so that's purely going to be debit the buyer only. Here's an interesting one. Seller's concession to buyer's costs. Sometimes the buyer hasn't got the money to pay for the closing costs, so they add a little bit onto the purchase price to pay the seller, and then the seller hands back some of that money into the kitty so that the closing costs can be paid for. In which case, it's going to be out of the seller's pocket into the buyer's pocket. So therefore, it's debit the seller, credit the buyer. Oh, and there we are. We've come to the end of that. So you may have to go through that again. So hope you enjoyed it, and let me know any feedback, please. Thank you.